All right, I will start to try and stay somewhat close to the time frame, and actually enough people stayed. Usually when I'm invited to either be on a panel or speak, it's the last time frame on the last day of the conference, and I think there's a reason for that. But nonetheless, this one at least there's somebody after me who's important, and then a reception, so there's some reason to stick around. So I'm Rob Grossinger with the National Community Stabilization Trust, and I will introduce our panelists in a minute. But what I wanted to do was distinguish what we're talking about. So the title of this is Financing Home Rehabs in Distressed Neighborhoods. What we're going to be discussing is acquisition, rehab, and resale. So financing for acquisition, rehab, and resale, or responsible affordable rental. We're not going to be talking about homeowner loans for rehab. Not that that's not important. That's just not what we're talking about. So whenever I talk, I'm always accused by my family, friends, colleagues of walking a line and sometimes falling off the line between gently shaking the trees and burning all my bridges. So today, it's really important that I just gently shake the trees, because what these panelists are going to talk about is really important and should be really important to you, but is definitely really important to me, and they all need help. We all need help in this space. And I'm going to lay out a couple of the reasons why, and then I'm going to turn it over to them so they can talk about what they're doing, but more importantly, hopefully when we're done, there are some people in this room who will think, well, maybe I can help here. Maybe there's something I can do. We'll try and keep it low on data and more begging, pleading, and cajoling. So why are we discussing this? Why are we talking about financing for single-family acquisition, rehab, and resale? Up until 2007, 2008, and I have been working in this space, the affordable housing space, in different capacities since 1980. And all that time, my focus has been on multifamily, because in my mind, and most of my colleagues' mind, the single-family mortgage market took care of itself. It had huge political influence through the realtors and the home builders. It was mom, apple pie, baseball, and home ownership. It didn't need any help. That market worked on its own. We were not really aware of we knew about it and understood it, but didn't really take in all the discriminatory practices within home ownership lending. We were all aware of the contract for deed scandals in Chicago in the 50s and 60s. But nonetheless, we focused on, and it was talked about earlier today, I think Carol mentioned it, bringing the balance of rental up in some way in the public domain, close to home ownership and also production of affordable rental. And that's what I focused on, that's what I cared about. And then 2007, 2008 happened, and all of a sudden we realized the mortgage market can actually be broken. Wall Street did a wonderful job of helping us break it. We focused on foreclosures for a while afterwards, and you still heard it referred to today as the foreclosure crisis. But something else was happening, and it was starting pretty quickly after 2008, and that was a change in ownership. Houses were starting to go from home ownership through foreclosure to rental. Now, we've been talking about cash all day today. Cash buyers, capital, cash. It's not that these cash buyers were walking in and they had grown the cash in their backyards. They were getting capital as investments from the same people that all of us in this room go begging to all the time. The teachers' retirement funds, the socially motivated, which I don't believe in, funds that do investment. The different people who have large, large sums of money, the for-profit community in 2008, 2009, not even people who had any history in real estate, started going to these funds saying, I can make a good return for you. I can make 15 to 20%, and based on my exit strategy, I can push it up even above 20. If you'll give me $100 million to go buy single family at these low, low prices, and I will rent them. I will rent them at a much bigger ROI than I would get if I resold them. And that process started in 2009 and 2010 and got bigger and bigger, and more people invested in this asset class. And more property started to flip, not flippers, but flip from home ownership to rental. Two statistics that came out actually fairly recently. The number of single-family homes that are rental went from 17% in 2008 to 23% in 2016. That may not seem like a lot, but single family is the largest rental opportunity in the country. It's higher than multifamily. There's a lot of single family homes that are rental. And so for that increase to go even further from 17 to 23 is big. Put it in units, 5.6 million homes over that same time period went from being homeowner occupied and owned to rental. Does that end the world? No. Is it concerning? Yes. What's also concerning is now you have the GSEs financing this activity. They tell the little white lies that we all tell. No, 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 we're just providing liquidity. No, 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 we're just doing a pilot because we want to learn about the market. It's a new asset class. We want to learn. But when the result of one of those just learning sessions is a $1 billion bond issuance for a single family rental institution, it's not just a little pilot. It's not just a little learning experience. And Freddie Mac just did one the other day, direct through one of their seller servicers. So the capital is not flowing from behind people's houses to cash buyers who are beating out homeowners and beating out responsible local people who might want to use it for rental, keeping it affordable. The cash is coming from the same places that we all would like to see cash come to do the things we've talked about all day. So the barbarians aren't just at the gate, they're through the gate. And they are in this for a long time. Their economic model produces more money than for sale. ROI on rental is higher than it is for sale. And they're committing to their investments, their investors and their investments, a 10-year hold period at least. And I've had many discussions with some of these folks where they see this as a very long-term hold. There's not going to be this exit strategy everybody was worried about. Oh, in 5 years, they're all going to sell off and glut the market again. They're going to hold for a long time. Here's the answers, some of them. But most importantly, the answers are in this room. Can you help? Can you find ways? We talked earlier about not using products, but thinking about different ways of doing it. Can you help? That's the end of my cajoling, begging, and pleading for right now. I'll be back for more pleading later. So I'm going to start with, they're sort of not in order here, but it was very rough, told where you had to sit and how this had to be on your... So I'm going to start with Stacie Young from the Community Investment Corporation, and I've known Stacie forever. Her bio is in the paperwork, so I'm not going to state it, but I am going to turn it over to Stacie.
Great, great. So I think I'm going to call the name of my presentation Crowding Out the Barbarians. I think that's a perfect intro. Thank you, Rob. So I'm Stacie. For those of you who aren't familiar with Community Investment Corporation, we finance acquisition rehab loans, mostly in low and moderate income neighborhoods, mostly to unsubsidized small to mid-sized developers. This is the flip side of the naturally occurring housing stock that the last panel talked about. So we're talking about the distressed market. So Rob just described, these are the distressed markets at the very beginning of today. The really tough markets. There isn't a lot of home ownership demand. These are tough markets. And the naturally occurring stock there is affordable because the values are low. And at CIC, this has been our core business since 1984. In fact, we perhaps built the ark for Noah. Did you get that?
Okay, we're no longer friends.
I head up a policy collaborative called the Preservation Compact. This just means lots of different stakeholders getting together to come up with strategies to preserve affordable rental housing. Government, for-profit and nonprofit developers, civic groups, tenant advocacy groups. We're looking at basic strategies for the most part. Think about operating costs like energy and property taxes. And we're also trying to come up with ways to preserve the overlooked parts of the stock, like 1 to 4 unit buildings as rental. So as Rob said, we were one of the groups thinking about 1 to 4s as rental. We got a bunch of our partners together and said, how does the 1 to 4 stock relate to the rental stock? To find out that these buildings comprise half a rental stock. And so, of course, like everyone in the room, after the crash, we saw these vacant, distressed buildings in all sorts of neighborhoods, the toughest markets. There wasn't any homeownership demand. And we said, what can we do about this? These are tough markets. We knew if we could rehab these buildings, if we could get these buildings rehabbed and rented out, not only are we improving the neighborhoods, we're revitalizing the neighborhoods, we're providing affordable rental units to the people who need it the most, and of course we're putting properties back on the tax rolls. We know our borrowers at CIC, we've been doing this a long time. These are entrepreneurs. Most of them are for-profit developers, and we thought they would have seen this as an opportunity. These are buildings, vacant, distressed, at a very low price. How come our developers weren't out there redeveloping these buildings? So we asked them that question. And we said, why aren't you guys out there? And they said 3 reasons. Number 1, when we try to finance these things, we can only get financing for 1 or 2 buildings at a time. Number 2, indeed, the values are low and so are the appraisals. And number 3, there's a very high transaction cost to trying to untangle this one building and then buying the next, and that makes this activity quite inefficient. And so in response, CIC developed 2 different programs. One is a financing pool to finance these buildings, groups of these buildings, and one is an acquisition pool. So I'll start with the financing pool. We structured it a special way to accommodate those low values. And there's some of our lenders in this room that help to commit money to this pool, PNC, Northern BMO, a couple of others. And the whole idea was, in order to get to these low values, we allow for 120% loan-to-value ratios, and that's because these are high cash flowing properties, and so we can require debt cover at 1.25. So in other words, there's high demand for these properties. They're big units, they're close to the ground, yards for your kids to play in, and so we were able to structure it in a way to accommodate those challenges. This pool targets groups of 1 to 4 unit buildings, and the idea there is to get to scale, to try to get some geographic concentration in order to maximize impact. And that pool has motored right along. In fact, last year we expanded it. It's now a $48 million pool. We have financed $19 million to help 325 units. Now, around the time we were launching that pool, Chase came out with this Pro Neighborhoods grant program, and we got together with a couple of our favorite Chicago CDFIs. Do not tell the other CDFIs I said that. NHS Chicago and Chicago Community Loan Fund, and we put together a proposal that focuses on the 1 to 4 stock. And CIC took $1.5, and we got the grant. CIC took $1.5 million to create an acquisition pool, so that this makes us a nimble cash buyer, doesn't it? So we can go out and we can buy these buildings, we sell them to developers who are responsible. We're checking their track records, we're making sure that they do a good job. And this solves the problem of assembling the properties. And so those high transaction costs that our investors complained about, we solve that problem. We're bringing the units we're buying the units, and we're able to sell them back to the investors, the responsible investors who are interested. NCST is a great resource for us, along with some other strategies. The great thing about the acquisition pool is it allows us to target the neighborhoods and blocks that we care the most about. So we can acquire the properties where we think those properties need to be fixed up and sell them back to those developers who will fix them up and either rent them out or sell them to owner occupants. And with that pool, we've acquired 430 units, and our $1.5 million has revolved. We actually spent $5 million to acquire those 430 units. And now is when Rob told me to talk about lessons learned. He said, talk about the good, the bad, and the ugly. I'm very good at talking about the good, and of course at CSE there is no bad or ugly, but I will do my best. I will talk about a couple of things. Most important lesson learned, it is working. The neighborhoods are stabilizing, and we can see this for 2 reasons. One, on our acquisition pool, it used to be the developers who were buying were mostly renting them out. About 15% went to owner occupants. Now, 3 or 4 years later, it's about 40% home ownership for our developers that we're selling to. The second thing, on that financing pool, we thought we were going to have to go to 120% loan to value. The values have stabilized. We're generally at about 80 or 85% loan to value. So these strategies are working, and it underscores the importance of the quality of these developers. So we're vetting these developers and investors, and we are supporting their private market-based strategies, which are far more efficient and able to get to scale because they don't have to mess around with these slow, cumbersome subsidies. Now, one reality check we had was we can't serve all buildings and all developers. So on the building side, again, we're working with the private market. If there is a building that has rehab costs that exceed the value, that's a good deal for the government subsidy to take care of. And we decided there are enough distressed buildings out there. We look at the financial feasibility, and these developers will take care of the ones that are financially feasible, but those really, really tough ones, a government program is going to have to take care of those. The same is true on the developer side. We are looking for developers with track records. I appreciate that Mrs. Jones wants to buy what she really wants to buy, that 2-flat next door. That's not the right candidate for us. So we couldn't serve all buildings and all developers. And finally, we learned something about using resources in a smart way. So we took that Chase grant and we put it into a revolving pool. So that pool has been evergreen. We thought that maybe it would be a sinking fund, but it hasn't been. This has been a self-sustaining activity and has actually helped to generate some revenue in the process. The other thing on the financing, the $48 million financing pool, we did get government money for that, and we used it as a loan loss reserve. That means we didn't have to worry about the government subsidy getting all sorts of government requirements that make our lives miserable and our developers' lives miserable. And so to summarize, we did our best to help out the private market developers who aren't using any kind of subsidy to help them get to scale. And I feel like all day today we've kind of hinted at this idea. How do we work with the unsubsidized stock and do it in a smart and strategic way? And if we can focus on the high quality developers and crowd out the barbarians, all the better for our neighborhoods.
Thanks, Stacie. I want to introduce Debbie Campbell now with the Community Housing Capital. Debbie is going to talk, and I'm not going to say anything about her other than another good person that wants help from all of you.
So, Community Housing Capital is a CDFI impact affordable housing loan fund, and we lend nationwide. And we were one of the early partners with the Stabilization Trust, and that's really where we piloted and evolved together a model that works very well for our borrowers who are members of the NeighborWorks network to acquire underutilized foreclosed homes and renovate them and sell or rent them as affordable. It's a tough space to be in because, as you've heard some about today, scattered site single-family housing initiatives are hard to finance. They're complicated, they're high touch, they're expensive from a staffing standpoint to deal with. So you need to really norm the way that you do it and evolve it so that it's very efficient and you've cut out any expenses and any hurdles that you can cut out. Because also on single family properties, if you think about price points, they're really sensitive to an extra $2,000 in closing costs that you could have avoided or that sort of thing. So we've learned a lot of lessons with the trust. I think we're the largest user, I think, of the Stabilization Trust. And it's been a wonderful building block for us to figure this out and grow from. So I took a look at our portfolio and I broke it out just to the properties that we've run through the trust, because I think that gives us sort of a homogeneous group to talk about. So since we started working in the trust in about 2010, 2011, we've done $64 million in activity with 14 borrowers across 9 states, and they've produced 400 homes. It makes so much sense to make this model work. It costs about 30% less to preserve a unit of single family than it does to build one. It takes a lot less time to bring them online. There are a lot of reasons why this makes sense. The challenges, though, are that it is a complicated line of business for both the lender and the borrower. The borrower who's acquiring these properties, they really have to have a lot of knowledge and expertise about how to acquire and how they're going to renovate and not having surprises that are going to make the property impossible to recover their money on. They, for us, one of the things is that when you look at scale and you think about affordable housing, especially in the context of multifamily, 400 units and $64 million, people, you know, it's a drop in the bucket by comparison to the volume of units and the amount of money that you can deploy and the leverage you can achieve in the context of multifamily. So it's been, I think, hard in this work to attract the attention that it deserves because the numbers do seem low in comparison. Sourcing capital that matches the best practices to make these models work is hard. For our borrowers, in a lot of instances, they're competing also with cash borrowers. And the rental model, as Rob referred to, where it's more lucrative, starts to drive up purchase prices because people want to operate them on a cash flow basis as opposed to thinking of them as someone's home. And it can have such a detrimental effect on an entire neighborhood. Finding enough qualified buyers in a lot of these communities is hard. And one of our large buyers, who I'm going to talk a little bit more about, CAPC, which is in New Jersey, was one of our early trust borrowers. And the Stabilization Trust was sort of like a participation loan program almost, to explain it in really simple terms. And it spread the risk and it leveraged the money in a really effective way. But what this one borrower ran into early in the program was that they couldn't always find a qualified buyer. However, providing quality single-family housing stock in the neighborhood that was affordable as a rental was also a really important endeavor. The snag was, who do you get to finance a scattered site rental portfolio? It's hard. You know, single family, it's nearly impossible. So we've kind of figured that out. So how did we do it? Well, we worked with some of our investors. We worked with Wood Forest. We worked with Calvert Impact Capital to secure unsecured investments in CHC. And we use that money to offer lines of credit to borrowers like CAPC, and they revolve and they go out and they can compete with the cash borrowers because they have instant, easy access to their money. They can come to us. Construction draws are also a big deal because when you have these organizations, sometimes they're smaller, certainly smaller than the multifamily producers, and so they can't wait 30 days for a draw because they're already out of pocket for the money. So we have a really strong servicing department, and we are able to do pretty much on-demand draws, and then we bill our investor partner monthly, and we do all of the compliance reporting. And so what Calvert has done with us to make this really, really easy is they have put together a $15 million facility. $10 million of the money in the facility is Calvert's, and they have allowed private foundations, community foundations, family funds to come in and co-invest beside them. Calvert's already done the due diligence. They've already got the documents, and the investor comes in and invests in us side by side with them. We have one set of shared covenants. We make one payment to Calvert. It really creates great efficiencies. And then Calvert and CHC have also worked with this borrower, CAPC, that I talked about, to create a senior debt instrument for their work. And they've also been able now, because of their track record, to bring in an equity investor. So they're really ramping up, and in the next 3 years, they anticipate that they'll do about another 165 additional units, which for an organization that size is really impactful in the communities where they work. So, you know, what can you do to help us? Because we've built the system, we know how to deliver it, but for capital. So there you go. We're ready, our borrowers are ready, happy to answer other questions if you have them, but try to move through all of these interesting conversations.
Thanks, Debbie. And I'll do the begging for you at the end. Our next guest, it's like a talk show up here. Our next panelist is who I like to refer to as our guy at the Office of the Comptroller of the Currency, Barry Whitus.
All right.
Everybody has to have a guy.
A guy. I'm the guy. I'm the go-to guy if you got a problem. So what we do in our office at the OCC is to help communities and banks that are trying to do community economic development work find best practices to pursue as part of their CRA programs to help with community development efforts. And one of the recent issues that arose that we got asked to get involved with was back in 2015 when the city of Detroit was trying to set up a program to be able to sell their land bank properties to individual homeowners. And we had some banks that were very interested in getting involved in providing either acquisition and rehab financing to retail buyers or to investors that would purchase the properties and then resell them to homeowners. What we heard from the city and from the banks was that OCC's and the regulatory agencies' policies, excuse me 1 second, or real estate lending guidelines were a real inhibitor to banks being able to provide this financing because of the appraisal gap problem that was persistent in the inner city in Detroit where these land bank properties were. So we went back and did some homework on this, spent some more time talking to the banks and community-based organizations, and came up with a policy that I wanted to walk you through here that'll just take a couple minutes that I think may be a great tool for some banks to be able to use to be able to provide the financing either to a retail buyer that wants to rehab the house or to an individual buyer that wants to purchase one of the rehabbed houses that you heard about by other panelists. So if we could move to the next slide, please. Let me just sort of walk you through the problem and how we think we fixed it. So under the real estate lending guidelines that all the bank regulatory agencies are subject to, that are subject to the banks to, we require that a loan in excess, a mortgage loan in excess of 90% of value have appropriate credit enhancement. And that usually would be mortgage insurance is typically what you see for loans at that level. And the problem here was, of course, that you were looking at properties that have an acquisition and after rehab appraisal investment that's greater than the value of the property, at least initially, given the nature of some of these communities. Now, we do have, within those real estate lending guidelines, some flexibility to say that we will permit loans above this 90% loan to value without credit enhancement on an exception basis. So that's what we chose to do in terms of issuing this policy. So if we could go to the next slide, let me walk you through what this policy is. So what we did is we put out this policy that said, look, if a loan meets eligible standards, which in this policy is less than $200,000, the property is located in an eligible community targeted for revitalization by a governmental agency, the bank can structure a program, come back to us with the policies and procedures that they want to implement as part of this program, and give the OCC 30 days notice that they intend to start originating loans under this program. And during that time period, we can engage with the bank, and if necessary, they can make corrections. but after that 30-day notice period, they can then begin originating these loans. So let me just go through the details real quick on the next slide. Of course, as I said earlier, we're talking about making loans with a loan-to-value of 100% or more value without mortgage insurance or collateral. We don't set a cap or a ceiling on the total loan-to-value. It can be as much as the bank is comfortable doing. But it would be a permanent first lien mortgage for the purchase of the property and the purchase and rehabilitation of the property, which could include, the projected rehab costs if it's a buyer that's purchasing and is going to do the rehab themselves, or if they're purchasing a property that one of these organizations or another local developer has already rehabbed, as long as they're purchasing the property within 6 months after the rehab was completed by that third party, that would also be acceptable. It's an owner-occupied property, and this would really, as I said, just be for first lien mortgages. We're not proposing this for home equity loans, lines of credit, or refinancing programs. So if we could go to the next slide here. What we would expect is the bank to, in their application to us, define the geography or eligible community where they wanted to implement this program. They would describe how the bank's program would support local revitalization efforts, and this is particularly important. We want to make sure that the buyer of the property, the person that's borrowing, knows very clearly that they are purchasing a property and getting a loan that is in excess of the current market value of the property, which is a problem that led to much of what we ended up with in the financial crisis. So we don't want this to be a problem again, that the borrower not realize that they are taking significant risk, and also notifying the borrower that there is the likelihood or possibility that the market value could be less than the original loan balance for a period of time. And that the potential for that borrower, if they needed to sell before the property had risen in value to what their outstanding loan amount is, that they would potentially have financial liability if they're selling for less than the amount of the loan, than the amount that the loan is outstanding. So let me go to the next slide here real quick, and then we'll sort of see where we're going with this next. We've had a number of conversations with banks. We've had a couple banks that have actually implemented programs, and we've had a lot of conversations with banks that have said, that's a very interesting program. It's consistent with what we want to do as a bank, but some of the guidelines are a little different than what we had envisioned or what we had worked out with our local partners. And so what we've also written into this policy is that we said that we're willing to consider on a case-by-case basis other proposals by banks that support revitalization in distressed communities, as long as those efforts are consistent with safe and sound lending practices, promote fair access to credit and fair treatment of borrowers, and complies with all applicable laws. And that's sort of where we are with a number of banks in terms of our conversations. And what we want to do at this point going forward is to try to get the message out to localities, community-based organizations, to other bankers to say, look, this is a possibility. If you have banks that really want to be involved in doing rehab lending in some of these distressed communities where these upside-down appraisals are going to be an inhibitor to the deals getting done, come talk to us as the regulator. We're the supervisor for national banks and federal thrifts. And we have a team of community affairs officers that work throughout the country that are your on-the-ground points of contact to begin these conversations with. In your package today, there's a one-page flyer that's a high-level description of a publication that we recently put out that describes this policy, that describes some examples of bank involvement in similar types of local single-family rehab programs with community-based organizations. And it also has links to this policy on the OCC's website that I just walked through, as well as the resources that you could reach out to that work with the OCC to begin a dialogue about how you might be able to use this program as a bank or as a community-based organization or governmental agency how you might approach the banks that are operating in your markets to pursue a program like this. So anyway, we hope that by coming up with this policy, we can help move the needle on what has been a protracted issue in these distressed communities for some time. And we hope to be able to continue to publicize successful strategies, best practices, cases where people have been able to use this policy and successfully rehab houses get homeowners in them, and hope that other banks will pick up recognizing that this is an important component of the housing stock where so many people are trying to get into homeownership, and that low end of the housing stock is really becoming very problematic in terms of available houses for people to purchase. So anyway, that's the policy, and happy to answer questions once we get to the end.
Thanks, Barry. And our last contestant is my colleague, Julia Gordon, from the National Community Stabilization Trust, who's going to talk about an opportunity and sort of be the last person talking about something positive, except it would require congressional action and presidential signature, but that we'll worry about that later. Julia.
Thanks, Rob. Way to set it up like that. So before I launch into talking about this specific proposal, I just want to say a couple of other things, keying off of lots of things I've heard today, which is at the National Community Stabilization Trust, where we work all over the country right now, primarily in 28 more distressed markets. What we hear from our buyers is some things that previous panelists have mentioned, but I really want to underscore. The obstacle in some of the markets that we work in is not that there's no one interested in homeownership. There are families interested in homeownership. There are families who qualify for a mortgage under the sort of typical middle-of-the-road credit box. What they find the obstacles are, and Elena talked about both of these two things before, is the ability to access these small balance mortgages in these much less expensive markets, and finding the house. And even the organizations that are doing acquisition and rehab have trouble finding the houses because all of the investors are just all over the place. And aggressive and out there. You've seen courthouses around the country start to move their foreclosure sales onto online auctions, and they tell me the reason they did that was not just to be fashion forward on technology, but because basically every day they had an episode of The Sopranos going on in their basement, with the aggressiveness going on. So it's a little bit crazy out there. In some places it's letting up, but in some places it's not. And I happen to be a person whose view of sort of the financialization of housing, the entry of all these people whose interest in housing isn't about providing people with shelter or even just the real estate industry, but this could be pork bellies, whatever. This is not necessarily a good thing. I'm not sure over time that it's going to be any better for housing than private equity buying Toys R Us was for Toys R Us. So I think, I want to be a little more maybe judgmental than I've heard people be earlier today about this. With that, I am going to, stop going in that direction, because for those of you looking in this direction, there's this really, really large clock over there that tells us how much time we have left.
7 minutes and 22 seconds
and we
for
don't
you.
have a whole lot of time left. So I want to talk about a legislative idea whose time has come. There are a number of people in this room, people and organizations that are working on this together right now, really starting with Buzz Roberts, who has been a prime mover in this area, Carrie Shea, who is here, Tom Carpenter, who was here before, Bobby Rosen. There's a bunch of folks. Chris Siglin was here somewhere at some point. And this is a legislative proposal to basically create a tax credit to support either rehab or new construction of homes in the more distressed markets that we've been talking about, where generally the cost of construction or the costs of acquisition and rehab exceed the fair market value of the homes. And just to answer a question I often get asked about that, is that throwing money down a black hole? The answer is in the kinds of neighborhoods we're talking about, and we know this from previous government subsidy programs that have worked on this issue. If you can start to get the market going with non-distressed sales, you can start to see the home values start to come back up. You know, we're not talking about neighborhoods that are, I don't know, to use a technical term, circling the drain. We're talking about places that can be viable, but where the appraisals have been brought down by a lot of distressed comps, or by the complete lack of comps because buying and selling isn't happening, like in Detroit. So here's this idea, which is just so simple, but yet powerful, which is, how about if we use a tax credit? And I promise I'll talk later about where you get the tax credit from. But how about if we use a tax credit to incentivize investment into rehabbing or both vacant and occupied homes in these neighborhoods, or constructing new homes on vacant lots, by using this tax credit to plug that hole. We had NSP to plug that hole. NSP went away. And what if we use this tax credit to plug that hole and said, you can get this tax credit, but only if this home is then sold to an owner-occupant. That would bring in the investment and then really direct that investment toward home ownership. There are a variety of limitations we have built into this proposal, parameters, both around how you define the distressed market and about how you define who a qualified owner-occupant is. For anybody who thinks this proposal sounds familiar, it might. It was actually a proposal during the Bush administration. In 2004, it had literally hundreds of bipartisan sponsors in Congress, and really only didn't get passed because it was on a vehicle that died and didn't go anywhere. At the time, it was much more targeted toward low-income homeowners. What we've done now is we've moved that up to 140 AMI, so that you can really bring moderate and middle-income folks into these communities to serve as those anchors that have been talked about earlier. And because this rehab tax credit applies not just to rehab of vacant or new construction, but also for existing homeowners, it's not going to be an incentive to push people out of their homes. It's just an incentive to bring that housing stock back up to where it needs to be, and then bring the homeowners in. What I want to end with, because I see the time is running out, there's lots of details to this. I want to end with where does the money come from? Is now a time in the history of our republic where we're going to create a brand new tax credit from scratch? Probably not. But the idea is to be able to use private activity bond money, which, folks, I didn't know this when I started working on this. The vast majority of states, really all but 3, I think, just leave tons of private activity bond cap on the table every year. And even though you can roll it over a bit, there's just a lot of money always being given back. And that seems like a waste. And we could convert that into these tax credits. It would be administered through the states using a QAP. You would have developers manage projects that, again, as folks on this panel have talked about, you will have projects that can be of a scale to make a real difference in a particular neighborhood, and the end result there is home ownership. Where does this stand right now? Well, there's legislative language to do all of this. There is interest out there. We are assembling a really impressive coalition. A number of you may already be part of this coalition. I'll just mention that recently the National Association of Realtors has joined this coalition, which is great news. We have some significant mortgage lenders that may be joining on soon. And of course, many of the affordable housing organizations represented in this room are already part of this coalition. Now that we have this coalition built, we are going to the Hill to assemble sponsors and support. And then when we want to have it all ready to go. Do we know exactly what the legislative vehicle is? We do not. Do we expect much meaningful legislative activity before November? We do not. But we really want to have this wrapped up and ready to go when we see an opportunity that presents itself. This is a win-win idea in so many ways. I have yet to talk to someone who thinks, oh no, I would be harmed by that proposal. And so without that kind of opposition, I feel good about the number of us who are spending a lot of time trying to get this ready to go.
4 seconds to spare. All right, so I'm going to open it up to questions for people, for our panelists. What I'm hoping is that all the financial institutions get behind those 2 microphones and ask Stacie and Debbie where to wire the money. Short of that, any questions that anyone has about how they work? Otherwise, I have 9 minutes and 40 seconds to bore the hell out of all of you. So, questions? Kristen. That was all you were doing? Say, shut up, Rob.
Nice work.
Banks from getting up and distributing money to CIC and CHC, which I wholeheartedly endorse. So we've done some work in Chicago and looked at the gap for new construction in low-line neighborhoods. We think the gap is about $50,000, right? You can maybe build a decent house for $230,000 in Chicago. You really need to sell it for $180,000. There's going to be a $50,000 gap. It's a little bigger if you do a 2-flat. Rehab, it's probably in that same area. So I'm just wondering, because I haven't read the legislation, the proposal on the single-family tax credit, do you think it would get to up to what dollar amount kind of would it help? Would it close that $50,000 gap that we see in Chicago, and we think if we could solve for it, we could put thousands of houses back online?
So first, I should say the name of this proposal is the Neighborhood Homes Investment Act. And there's a lot of information at neighborhoodhomesinvestmentact.org, including all of the different caps and percentages we've built in that will answer that question. And unless Carrie wants to, I don't want to answer off the top of my head with the numbers you've given me. Carrie, do you want to?
I would say that is exactly the sweet spot for that. I too am a housing developer. I do it down in New Orleans. Your numbers sound exactly like our numbers, which I'm surprised because you have basements, which we don't in New Orleans. But that's exactly for new construction. I would consider that to be the sweet spot for this program.
Yes, over here. Oh, I thought you was coming, but that's the camera.
Jog this afternoon. Question about, more of a question about desirability of single-family rental versus single-family home ownership. Obviously, you guys are not the vulture investors or the barbarians. You're trying to prevent them from investing in the housing stock. But still, what thought have you given to, because for every unit you make a single-family rental, that's a unit that's not available for single-family home ownership. And the way that most Americans have acquired wealth is through home ownership. So we also want to, you know, in the wake of the foreclosure crisis, we also want to preserve and promote opportunities for people to acquire wealth, particularly people who are victimized, disproportionately people of color who are victimized by the foreclosure crisis. So on a neighborhood level, has anyone in the panel done thinking like, okay, we shouldn't make more than X units rental, we want to preserve Y units for home ownership? I don't know if there's a tipping point or whatever, but you know, obviously you want a mix of this stuff. You know, what type of thinking have you done about this question?
I can tell you that the borrower who I was talking about, while we haven't imposed a quota, their program is about 66% ownership, and for the people who are in rental, they're doing home buyer counseling and borrower readiness and those sorts of things. Another one of the programs that we work with in Texas, when they have a renter, they don't run a rent-to-own program because the resident is not forced to buy the house that they're in, but they're helping them to become buyer ready. And if they become buyer ready and find a house, whether it's their house or not, they let them out of the lease without penalty to go and buy. And if they buy a house that the organization owns, not necessarily the one that they're living in, they will let them use their deposit toward their down payment. So they're already building in mechanisms because they're neighborhood preservationists, and at the hearts of their being, they do believe in home ownership.
It changed color. Go ahead, Stacie.
And
then
it
Julia.
changed color, holy
I know,
cow.
we're in the
talk-
danger zone now.
I'm really good at talking fast. So I used to sell vacuums. So to answer your question, we do a lot of geographic targeting. The whole idea here was that these buildings were vacant and distressed. And if there are homeowners, owner-occupants who want to buy them, that would have been awesome, right? It was either fix them up and rent them or leave them vacant. And so we have been targeting areas where there is no owner-occupant demand. And as I said, our measure of success is actually that home ownership has increased. For our acquisition pool, our developers are selling these to owner-occupants. And so these are our financing tools, our acquisition pool. We're not going to use them in areas for rental if there's already home ownership demand.
So I just want to quickly say that at NCST, when we look at the properties that have gone through our platform, even though we do permit rental as an execution, which, you know, we have some of our buyers up here who do that, about 95% actually turn out to have been sold to owner-occupants, which we're very pleased about because we really do want to support home ownership. But it is really true that in some neighborhoods, there isn't a home ownership market right now. But if you want to preserve that stock, you need to get it into the hands of somebody who's going to rehab it before it literally falls down. Because these investors all over the world who are buying from the safety of their laptop, and they never even see the thing they're buying, will just sit on it until, you know, sort of famously, like some of the row houses in Baltimore, you know, the front of it just one day comes down. And I actually think it's really a shame that this community was not really ready or positioned or willing when these homes were at their most affordable right after the crash, to go in and get these things and save them. Imagine if FHA had taken all that REO and worked with this community here to secure those homes, to preserve them, you know, maybe to do rental until folks were ready to come back in home ownership. The landscape would look a lot different than having done the giant fire sale to private equity.
Pam over here has a question.
Hi, I'm Pam Daniels-Solisi from BMO Harris Bank. It was something that Barry had said in terms of a disclosure to the homeowners that I'd like to pose back to the panel. It's interesting to me because we all use the word communities, and sometimes I'm never sure if we're talking about real estate or we're talking about people. So when you're doing your program, how do you distinguish when you're really talking about what you want to do for the real estate versus if you're looking at it from the lens of the people? Because I often wonder if I'm a low-income household, is the best strategy for me to build wealth is to be in a distressed neighborhood? And how do you reconcile that in terms of making that distinction of when you're looking at real estate, houses, versus when you're looking at what's in the best interest for the homeowners or the households?
I think the answer from Barry is, it's way too esoteric. No, do you want to address Pam's in any way,
I mean,
shape,
was
or
this a
form?
question for you? Or?
Oh,
Okay.
Saying he asked that people, that part of the program was you need to disclose to
Yeah.
the homeowner that when you go in here in a low-value property, low-value real estate, as a low-income household, there are very big risks. This is different than what we hate about gentrifiers, that if it's a young couple who has no children to put in a school that's not working, who can pay for ADT, they may be in a position to invest in this low-value neighborhood and wait it out for 10 years, but how do you reconcile that for a low-income household whose
well,
income's not
in
going
the
to increase?
26 seconds left, I'll try and answer that, and I take some exception to Josh's comment about wealth building, because I think that was this country's modus operandi post-war. I think in 2008, we figured out that was kind of a crock. Pam, there's nobody in this room, I think, that, including me, that is talented enough to figure out how to weigh those sort of questions. Because in the end, we know real estate. Not many of us are good around people. Oh, well, we're good around people. We're not good with people in terms of saying to you, think about your future and what does this really mean and all that. But there are groups out there that do, and it's relying on the data and the information they have to help us decide what we should be. God, I'm in the red. This thing is, I'm not going to go have a nervous breakdown. I really think it's a difficult but worthwhile conversation, but when you're talking about real estate, that's not anything any of us are talented enough. I can't speak for all of you. I'm not talented enough to think those things through in my daily work. That's it. I want to thank the panelists.